Okay, in this lesson, we are going to discuss example for depreciation, right? Accounting for depreciation. Under whichever methods we use, the double entry is the same. Okay, that's what we have mentioned. Whichever method is used, the accounting entries are the same, right? The example given is we straight away you go to the example. Uh, Kim has a year end of 30th June each year. He has year ending for 30th June each year. His financial year is ending at 30th of June, right? So on the 1st January 2023, he purchased a car for 150,000, right? We have to open up a car account, cash account and car. Okay, cash or bank, cash or bank. Okay, we have not mentioned. Purchased a car for car account, right? Another one is depreciation account. Okay. First of all, we read the whole account, whole example. Kim has a year end of 30th June each year. On the 1st of January 2023, he purchased a car for 150,000. The car has an expected life of 5 years with an scrap value of 5,000. Prepare the depreciation under the both methods. So first of all, we will do under the straight line method. Okay, straight line method. Okay, so we will see under the straight line method, 150,000 in the sense, um, we will say 250,000. Okay, it is better to say 250,000, right? At the end of the value is 10,000. Okay, you will make the account the question like this way. Okay, straight line method and reducing balance method. Under the straight line method, we have to open a cash account, car account, and thereafter we have to open a accumulated depreciation account. Accumulated depreciation account, debit CR, depreciation. Accumulated depreciation. Other one is accumulated depreciation. This is debit, this is credit. Or provision for depreciation, or provision for, we can say provision for depreciation or accumulated depreciation. Okay, Four accounts going to deal with this. So under the straight line method, Kim has a year end budget, year end of 30th of June. So year ending is 30th of June, right? June 30th. Okay. Then June, July, August, September, October, November, December, January, February, March, April, May. July, July, August, September, October, November, December, January, February, March, April, May, June. Okay. July 1st. Starting date is 1st July, July of the previous year to this year, next year's 30th June, the financial year, accounting year for his entity, right? Then second one is cost. Cost, you say cost. Uh, cost. Cost is 250,000. Okay. Then scrap value, the car has an expected life of 5 years. Scrap value, lifespan, usage of life, how do you say? Lifespan is span is 5 years. Okay. Then the with an expected scrap value of 10,000, right? Scrap value is 10,000. This is the important for the straight line method, right? If it is a right, so this is the straight line method. Okay, so when you doing this account under straight line method, per month depreciation charges, cost is 250,000, right? Cost less scrap value, scrap value 10,000. Then we had to make for the depreciation 240,000. 240,000 for 5 years. 240,000 for 5 years. For 5 years. For 5 years. Okay. Then each year cost will be chargeable depreciation means 240 divided by 5. Okay. 240 divided by 5. That means 48,000 per month. Okay. 48, not 48,000. It's 240 divided by 5. 48,000, yes. 48,000. Okay, 48,000 per year. Then here charges, we have to say 48,000. Cash account credit 48,000 year 1. Okay, 2000 and year of 2002 no 23 no, we can say year of 20 now is 2020, right? We can say year of 2020. Car purchased for 250,000, right? Car account debit 200 2020, right? Here cash 150,000, right? First year depreciation is 48,000. So depreciation account debit 48,000 year 1, year 1 48,000. Accumulated depreciation account credit to year 1 48,000 means accumulated depreciation. Okay, depreciation. Here you will say depreciation. Okay, 48,000. So you have to balance the account. Year 1 balance carried down 250,000. Okay, year 2 year 2 balance brought forward is 250,000, right? Here year 1 balance carried down 150. Year 2 balance wait 150,000, 150,000. Year 2 balance brought forward 150,000. Okay, then accumulated depreciation, it's depreciation charged to profit and loss account. 48,000 year 1, right? There is nothing brought forward or carried forward. Year 1 48,000 balance brought forward 48,000, right? Year 2 balance brought forward balance is 48,000. This is the first year. Second year, again we are charging. There's no changes in cash or car. We are charging the depreciation. Year 2 accumulated depreciation 48,000 and accumulated depreciation year 2, depreciation 48,000. Balance sheet 96,000. Here also 96,000. Balance year 2 carried down. Balance 96,000. Year 3 brought forward balance 96,000. Here P&L 48,000. There is no carried forward or brought forward. Okay. Here cash or bank also no adjustments. So year 1 carried down balance 250,000. Okay. Year 3 brought forward balance 250,000. Like that, here also carried down balance 150. Year 3 brought forward balance 150,000. So in the year 3 also depreciation account same accumulated depreciation 48,000. Right. Here depreciation year 4, year 3 depreciation 48,000. 144,000. Okay. This is 100 and year 3 carried down 144,000. Brought forward year 4 brought forward 144,000. Okay, this is the entry we are passing for this particular exam. You would have understand why the credit and debit entry did not change. Okay, so for this thing, for straight line method, it is lifespan is 5 years. 5 years. In the last year, we will say in the balance sheet and profit and loss account. Okay, profit and loss account. Last year only I am going to show you debit and credit. P and L here balance sheet. Debit and credit balance sheet. Okay, balance sheet. Here is non-current assets. Non-current assets. Right. Here current assets. Here current liabilities. Right. Current assets and current liabilities. Hmm. So cash and bank is credit balance. So we are showing under the current liabilities, cash and bank. Year 4, year 3, yeah, okay, year 3. This is year 3, okay. Cash or bank, 150,000, okay. Current assets, car. Car is the current assets. Car, 150,000. This is we say profit and loss. Profit and loss. This is balance sheet, okay. Balance sheet, okay. Next one is car we have taken, cash we have taken. Next one is depreciation. Depreciation coming under the distribution expenses. Distribution expense, okay. We say depreciation. Depreciation, okay. Depreciation come on 48,000, okay. Provision accumulated less accumulated depreciation is 144,000. 250, right? This is 250, this is 250, okay. 250, okay. Year 4 brought forward 250,000, okay. 250,000 48, and we'll say accumulated depreciation 144,000, then book value is 106,000. The book value of the machinery is 106,000. 144 is accumulated depreciation or provision for depreciation. Car purchase value is 150,000. If we deduct the 144,000, then it comes to 106,000, okay. Balance is shown in this thing. We don't deduct it from the cost, right? We will have a separate account for this. So now we can say under the same principle we are going to see under the reducing balance method. Under the reducing balance method, okay. Reducing balance method, okay. So under the reducing balance method, right, under the reducing balance method we don't bother about the lifespan. Okay, we don't bother about the lifespan. We don't need to search for the information lifespan. We have to search for the information of the cost and scrap value and the percentage at which it is depreciating. We can say here depreciation policy is 25,000, 25%, okay, 20%. Depreciation at the rate of 20% on reducing balance method. Okay, so we are going to open a cash and bank account. Cash and bank account. Cash and bank plus car account. Okay, this is debit CR. Cash or bank. This is debit and credit. Car. Okay, car account. Other one is depreciation account. Depreciation, debit and credit. Okay. Other one is accumulated depreciation. Right. Okay. In this way, in this we have to say year one. What is the depreciation at the rate of 250,000 on cost, right? 250,000 into point 0.2, 240,000 into point 0.2 is 48,000. First year, the depreciation charge is 48,000, right? First year, we are purchasing year year one, you are purchasing the car, cash account credit 250,000, right? Car account debit year one, cash 250,000, right? First year depreciation is 20% into 240,000. So 20%, 20%. Okay. So first year depreciation is 48,000. accumulated year 1, right? Accumulated depreciation. Accumulated depreciation year 1 depreciation 48,000. So we had to balance it. Year 1 carried down 48,000, brought forward balance 48,000 on year 2. 2. Okay. Here it goes to P&L 48,000. Right? This one carried down 250,000. Brought forward year 2, brought forward balance 250. Here it is 250. Here year 1 brought forward 250. Okay. Second year, it's the depreciation charge would be 258,000. 1, 2, 3, 4, 5. 250. Wait. 240 minus 48,000 into 38,400. 38,400. Okay, that is year 2 accumulated depreciation, right? And depreciation on year 2 38,000 depreciation. So both, under the both ways, the depreciation and depreciation, the accumulated depreciation, double entry is same, but the amount only differs. Right? First year it's same, second year amount is differs because different accounting policies we are adapting for depreciation. Okay, that's what we say used to say. Here second year also 48,000. Here second year is for 38,000 watt. Okay, I will explain to you later, and we can carry it down. Year 1, year 2 also 250,000, right? Brought forward, carried forward 250,000. Year 3 also 250,000, right? 250,000 brought forward. This is carried down. Okay, brought forward year 4, year 2, year 3, year 4 brought forward 250,000, right? Here also year 1, year 2 carried down 250,000, right? Year 3 brought forward 250,000, carried down 250,000. Okay, in year 4 brought forward 250,000, right? This 38,400 goes to P&L 38,000, right? Here it goes to accumulated depreciation, carried down 400, 16, 86,400. Year 2 carried down 86,000, 400, 86,400. In the year 3, brought forward 86,400. Then what is the depreciation for year 3? Year 3, depreciation is 30,720, right? Year 3 depreciation. Year 3 depreciation 30,720 accumulated depreciation. This goes to P&L 30,720. This go carried down year 3 carried down 30,720. 21 7 117,120 brought forward 117,120. Okay, here in the third year the accumulated depreciation comes to 38 1 117,120, and depreciation for the years 30,720, whereas under the straight line method 48,000 accumulated for the in the year of 3. Okay, in the year of 3 depreciation is 48,000. The year of 3 carried balance is 144,000 accumulated depreciation. Here, sorry, accumulated depreciation in the year 3 is 144,000. Here is 117,720. So that is the difference. Here is a flat amount. Here is decreasing. First year 48,000, second year 38,400, right? Here, 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 here are the same amount, 48,000, 48,000, 48,000. Here 48,000, 38,400, 30,700. So P&L and balance sheet. First we can see balance sheet. Non-current assets. Assets. Under the non-current assets, motor vehicle, car. Car cost is 250,000. Accumulated depreciation is 117,120. 880 to 132,800 is the carried balance. Here 106,000 carried balance. Here book value is more. Okay, and another profit and loss account, debit and credit. It is under the distribution expenses. Distribution expense expense it's shown under distribution expenses. depreciation is 30,720, right? This is year 3. This is for year 3. Year 3 only I have shown. Only the this one I have shown. Related account. Cash account is not needed to show, right? So you would have understand the difference between the straight line method and reducing balance method. In that, under the reducing balance method, the asset value will shown in degree increased value, right? Higher value. In the straight line method, it shows a lower value. Okay, 106,000 here. Here is 132,880. We have used the lifespan is 5 years, depreciation within 5 years. Here we have taken the 20%. At the rate of 20% it is depreciated. Okay, yeah, at the reducing balance method. Have you understood? So I hope to see you in next lesson, that is debtors and bad debtors. Okay, thank you for watching. Join with me in the next lesson.